With Greece and China still on the market's radar, what are the odds of a bullish resolution? And how far could stocks rally? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In this week's video, to help us assess the odds of good things happening relative to the odds of bad things happening, we'll look at contagion fears in Europe, support, and longer-term trends. We'll close the video with the question and answer, how far could the S&P 500 rally? In last week's video, we discussed contagion in detail. Just a quick update. Did Italian yields spike this week, and have they been spiking, looking like increasing fear over the last 30 days? The answer is still no. In fact, Italian yields are lower today as of the close on Friday, July 10th, than they were 30 days ago. Think about all of the bad things that have happened in the last 30 days. Greece could not come to terms with its creditors. They walked out of the negotiations. Then they called a surprise referendum, catching the markets off guard. The markets, for the most part, were hoping that we would get a yes referendum and we would get a leadership change in Greece, because for the markets, that's the easier path. Markets always like the easier path. Neither of those things happened. Then Greece came to the first meeting this week, and they did not have a proposal after being told they had 24 hours. Given all of the things that have transpired over the last 30 days, it's pretty amazing that Italian yields are actually lower today than they were 30 days ago. Similar situation in Spain. If fear was increasing about bad things happening in Europe, this yield chart would be spiking as it did in 2011. Spanish yields are lower today than they were 30 days ago. The bond market in Europe is saying it believes the probability of bad things happening in the next couple of weeks, it believes that probability is relatively low. Notice, we're saying the probability of bad things happening. We're not necessarily saying the probability of Greece staying in the Eurozone. These charts really speak to the probability of contagion. So the bond market is saying if Greece stays, that's probably a good thing. And if Greece is ejected from the euro, it may not be as bad as many believe. This chart is not predicting gloom and doom in the European bond markets in the weeks ahead. We'll shift gears for a moment and talk about the strength of the present day trend, which also tells us something about probabilities going forward. The CCM market model, it helps us discern between volatility to ignore. Volatility to ignore. Why is this volatility to ignore? The uptrend is still in place. If I ride this out, we move to higher highs. If I ride this out, we move to higher highs. So we're trying to discern between volatility to ignore, and volatility to respect. At some point, the probabilities deteriorate to a point where you don't want to ignore it and be patient anymore. You want to start taking defensive actions to minimize the damage. How do these concepts apply to being patient so far in 2015? As regular viewers and clients know, the market model uses numerous methods and inputs and time frames to help us discern between volatility to ignore and volatility to respect from a probabilistic perspective. One of the ways that we can do that is with trends, and we can also do it with Fibonacci retracements. What a Fibonacci retracement tells us and why it's useful. it is normal for a bullish trend to have givebacks and then to go on and make a higher high. So the question is this volatility to ignore so far? And what do Fibonacci retracements tell us about this move? Is it telling us that the uptrend is most likely intact, or is it telling us that the uptrend is most likely about to roll over from a probabilistic perspective? If you're a client, this chart will help you understand why we have been trying to be patient and why, for the most part, we have made very few defensive moves, especially when you look at it from a percentage perspective. Why? This is, right now, a 100% normal retracement within the context of this move. These levels here tell us that a bullish move from this point here to this point here, it is normal within the ebbs and flows of markets to have a give back from this point here to this point here, this point here, or this point here, telling us we have not even hit the minimum retracement threshold to get concerned about relative to the strong rally off of the October 2015 low. We have another area that's saying be patient. If we use this rally from here in December of 2014, this low, to this closing high, we are right in the meat of the Fibonacci retracements. So this is saying be patient. This is normal to retrace to here based on this to this, and we haven't even moved into this is a normal retracement territory. Moral of the story, we will continue to try to be patient. We also understand that if next week is red, we also have areas that tell us to keep an open mind about a bounce back rally. Why do we try to be patient? These retracement levels are telling us that the primary trend is still up, and this is a normal give back that is typically followed by a move to higher highs, meaning any red that we've seen in here will earn it all back and then some if the market is able to right itself. And everything we do speaks to probabilities, and probabilities acknowledge that bad things can happen. We're still in the try to be patient zone from many perspectives. Now let's shift gears to probabilities again, the probabilities of good things happening relative to the probability of bad things happening. This is a calendar here. This is the month of July. This is the end of June. Greece missed the IMF payment at midnight on Tuesday, June 30th. On that day, so before they defaulted, because the S&P 500 closed before the actual default, the S&P closed at 2063. This is an event that people have been dreading for literally years. It finally happened. Did the market tank? The answer is no. The market has actually gained 13 points since the default. What is that telling us? It's telling us that the market is trying to look past this whole situation. It's not necessarily telling us whether or not Greece is going to stay in the Eurozone. It's saying if they stay, that's probably a good thing and will probably move higher. If they exit, it might not be as bad as many believe, and we probably would eventually move higher, even if that came after another bout of weakness. Remember, price captures everything. When the market can digest bad news in a better than expected manner, it is typically a bullish signal. All of this between here and here is based on the knowns that we have today. If the information changes drastically, the situation can change, and that's why we always have to keep a flexible, unbiased, and open mind. Just as the observable evidence over the past week or so since Greece defaulted has been telling us to keep an open mind about good things happening, trends were telling us to keep an open mind about bad things happening in late 2007. Since there is no magic bullet from an indicator perspective, or a risk-on, risk-off ratio perspective, or moving average perspective, the market model is widely diversified. These are some intermediate term meaning somewhere between the 50-day and the 200-day, intermediate term daily moving averages on the S&P 500 used by the model. They're helpful. There's nothing particularly magical about them. The slopes here are telling us that the probability of bad things happening is higher at this point than it was earlier in 2007. This is a be careful, bad things may happen, especially from a probability perspective look. How does the exact same chart using the exact same moving averages on the same time frame look today? The answer is infinitely better. Here, blue is on the bottom and the slopes of all of the moving averages are down. Blue on the bottom, slopes of all of them are down. That would be a full-bore bearish look from a moving average perspective. We don't have anything like that today as of the close on Friday, July 10th. Blue is on top and the slopes of all three of them are still up. This look here doesn't tell us that bad things can't happen. It just tells us that the probability of bad things happening relative to the probability of good things happening is much more favorable in the present day than it was here, 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 or here. Things look a lot more confusing if we add price back to the chart. While this is telling us that we still have a relatively strong intermediate term trend, price is telling us that in the short term it's been very difficult and we've been in a very indecisive and jittery market. But this looks a lot better than this. Now we're looking at a similar but different set of intermediate term daily moving averages. You can see this is a risky period here. This is calendar year 2001. This is in the middle of the dot-com bust. This is a low probability look. How do the exact same moving averages look on the exact same time frame today in 2015? The answer is much, much better. Blue on the bottom, slopes of all of them are down. This is, I can't afford to be patient. This is, I can afford to be patient to try to see if support holds. And that's exactly what we've done recently. This doesn't tell us that support is going to hold, and it may indeed break. This tells us that the probability of support breaking or the market morphing in 2015 from a look like this into a look like this in a matter of days is extremely low. In fact, within a matter of days, it's almost mathematically impossible. So this is telling us to keep an open mind about better than expected outcomes in the weeks and months ahead. Let's take a moment and address a common question. What about China, Chris? China's relevant. And if the market believes that China's relevant, then it's very relevant. If the market can shake it off, then it's not as relevant. Typically, China is not nearly as relevant as a normal developed market. This line here shows the correlation between the German DAX, so German stocks, relative to the S&P 500. This is the zero level here. This is a very, very high and consistently high correlation, telling us that Germany and the United States, for the most part, zig and zag together. This is the exact same look comparing the Shanghai Stock Exchange to the S&P 500. This is the zero line. This is all over the place, and in fact, sometimes we have a strong negative correlation between China and the United States, telling us that it is not uncommon, and these are monthly correlations, so these are longer-term correlations. It is not uncommon for China to zag and for the S&P 500 to zig. So we need to keep an eye on China. The more unstable China is, the more relevant it most likely will be. The more stable it is, even if it's losing ground, if it's a relatively stable situation, it probably won't mean nearly as much as the situation in Europe. Let's shift gears now and ask, what can we learn about probabilities from support? This is a weekly chart of the EWG, or German iShares ETF. So this is German stocks EWG. This is 2009 here. Point of the exercise: support, bullish move. Support, bullish move. Support in the general area, bullish move. Long-term support. We just tested it this week. The weekly low came right down towards these longer-term trend lines and bounced. We also have numerous areas here. What once was resistance may now act as support. What once was resistance may now act as support. Moral of the story: this chart is saying to try to be patient. Why? Give-backs within the context of an ongoing uptrend are normal. Give back, bullish move. Give back, eventually make a higher high. Give back and pain, why aren't you selling my positions? Followed by a higher high if you're patient. Several weeks of give back. Why are we being patient? If we're patient, we eventually go on and move on to a higher high. This chart doesn't tell us anything about what will happen next week, other than it's prudent to try to be patient to see if long-term support and short-term support, possible support, holds. If price moves into this area here, our concerns would increase. This is a monthly chart of global stocks, so the ACWI ETF, which is basically 50% U.S. stocks, 50% foreign stocks. These are monthly closes here, and these are lows and highs. These are high-low close bars. There are numerous areas of possible support telling us it is prudent to try to remain patient in this general area here. We closed on Friday, July 10th at 59.72, which is above every single one of these levels. Doesn't tell us anything about whether or not it will hold. It's just telling us there is a basis, a rational basis, to remain patient to see which way this resolves itself. If we bounce, there are numerous reasons to think we could go on and make a higher high. The exact same concepts can be applied to any time frame, including a weekly chart. We closed on Friday above every single one of these horizontal lines. Relative to Greece, nothing is done until Germany signs on the dotted line. On Twitter, earlier this week, we showed that a recent poll shows that Germans are starting to soften up a little bit. A recent poll by YouGov says the percentage of respondents in Germany saying they would prefer to see Greece leave is at a 5-month low, and the percentage of people saying they would prefer to see them stay is at a 5-month high. So they still are voting in favor of kicking them out, but politically it might be a little easier today than it was a few months ago to agree to another bailout package for Greece. From a support and be patient perspective, it's good to keep in mind nothing says that 2039 is going to hold. If it doesn't hold, we have the Fibonacci retracements and we have other areas not too far below. So if something goes against the markets next week, we have to keep an open mind about flexibility. We will have to reduce risk, but we also have to be willing to redeploy capital rapidly if we hold at a logical level. It's been a frustrating 14 months for investors. This is May 1st of 2014. This is the NYSE. This is a broad measure of U.S. stocks. The level that it hit on May 1st of 2014 is the exact same level that we hit 14 months later, or this week, on July 8th. This is a very indecisive, frustrating market that's basically gone nowhere. It's important that we stick to our discipline. The market will not stay like this forever. It will eventually move higher or lower. It's not going to go sideways forever. So we have to stick to our discipline and keep an open mind, and eventually a stronger trend, either up or down, will emerge. The market model assesses risk on multiple time frames, which speaks to patience. This is the 200-day moving average for the German DAX here in red. Notice the slope of it. It's telling us that the longer-term trend is still bullish. Compare the slope of this line and where the 50 is relative to the same moving averages in 2008. This is telling us that the long-term trend is bearish. The 50 is below the 200-day, and for the majority of the time, price is below both. This is a full-bore bearish look in here, not what we have today. This is saying don't be patient and reduce risk. This is saying try to be patient and see how this resolves itself. In terms of the probability of good things happening relative to the probability of bad things happening, price action on Thursday of this week. This is a 15-minute chart. The high of the day was made basically on the open, and then people sold for the remainder of the day from a conviction perspective. The conviction to sell was greater than the conviction to buy. Contrast that with Friday's session. We spiked, then we started to sell off, and instead of never going on to make a higher high, early in the day we learned that things looked better. We went on to make a higher high. So price action on Friday and the fact that we didn't give back all the gains on Friday tells us that the market, from a probability perspective, was not predicting gloom and doom on Monday. Could Monday be ugly? Yes, it absolutely, positively could be very ugly. Everything we talk about here speaks to probabilities. We'll reassess the probabilities on Monday, given the knowns of the day. Revisiting our tweet from May 29th, where we identified 2067, 2064, and most importantly, 2039 as important levels. Think again about all the bad things that have happened in Greece, the referendum, not being prepared for the meeting, etc. And we've had high uncertainty and volatility in China. The market has never gone below the most important level, which was 2039. That's pretty amazing, and that's telling us to keep an open mind about better than expected outcomes. The strategy relative to this chart, for the most part, remains unchanged. If price moves into this area here, we will have to, by rule, reduce risk and do so at a much faster rate than the tiny little step-away moves that we've made over the past couple of weeks. Why? If we break support, the probability of a waterfall plunge is much higher on this side than it is on this side. What about bullish expectations. If you're a new client and you have a lot of cash, or if we're going to redeploy some of the cash that we raised recently. We did one buy on Friday. Why? The probability of bad things happening was lower on Friday than it was, let's say, any time during the past 2 weeks when you look at bond yields and the odds of a deal forming in Greece. Therefore, it was prudent to take a baby step back. But we need to see more. Price needs to prove it in this direction as well. Daily chart of the S&P 500, we still have a short-term downtrend. Lower high followed by a lower low. To break that, we need three things to happen. Eventually, we need to start making higher highs. Therefore, if we closed above 2085 on Friday, we would have moved more capital back in. So the more that we can see from an observable evidence perspective, things that we can see that the trend is now reversing, then we can scale back in at a faster rate. We scale back in at a rate that's in line with the rate of the improvement in the observable evidence. How do we do that? The market model helps us calculate that with the math and the hard data. This is a daily DeMark chart of the S&P 500. DeMark charts and indicators are proprietary tools from Market Studies, LLC. Point of the exercise. DeMark and propulsion can help us answer the question, how far could stocks conceivably rally within the normal bounds of how markets operate if support holds? This teal triangle here, and the red triangle and the yellow triangle, these are part of DeMark's propulsion tool. You can somewhat think of this as a magnet or an upside target. This is somewhat of a momentum level, and this is a downside magnet or target, telling us reasonable bounds that markets tend to move within. Having said that, what's the upper magnet look like as of the close on Friday, July 10th? The answer is the teal triangles and the new magnet are up at 2201 on the S&P 500, telling us that patience, if support holds, and notice the red triangle is down at 2035, telling us that we could have one more bout of weakness even within these bounds. However, if the market can right itself, rewards may follow with a move towards 2201 on the S&P 500 index. Given the uncertainties related to China and Greece, we will head into next week with a flexible, unbiased, and open mind. The model, the markets, support, the bond market in Europe, all of those things will guide us if we're willing to listen. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes. and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.